The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova 401k Associates webinar on cash balance plans. This will be presented today by Phil Allen, an actuary here at Nova. If you have any questions during the presentation, please type them in the questions box, and Phil will be answering them throughout the presentation. We have made the slides available as a downloadable PDF. Please click the handouts option on your GoToWebinar panel, and you should be able to save the PDF to your local device. Today's webinar is eligible for both Texas CPA and CSPCE. In order to receive credit, you must be registered individually, remain on the webinar for the entire presentation, and complete the survey that will pop up immediately after the webinar has closed. So please be on the lookout for that. It does pop up pretty quick, and it's easy to close out of. If you do have any questions, please reach out to me at webinars@nova401k.com, and I'll be happy to help you out. Bill, we are ready to get started.
Thank you, Andrea. As Andrea mentioned, I'm Phil Allen. I'm one of 4 actuaries here at Nova. And in typical actuarial style, we like to start off with an actuary joke, because not everybody knows what actuaries are. So just to give you an idea of what actuaries are, if you want to spot the difference between an outgoing actuary and an introverted actuary, the outgoing actuary will be looking at your shoes when they're talking to you instead of their own. I'll leave it up to you to decide which of those I fit into by the end of this presentation. We are going to talk about cash balance plans today. I will kick it off with a couple quick disclaimers. This is not intended to be any type of legal advice or tax advice. We are not lawyers or CPAs at Nova. That's why we were actuaries. We don't have the personalities to be either of those. Also, please consult a professional if you need any of that advice. This is intended for CPAs and financial advisors and also clients. If that's not you, you're still welcome to listen in and enjoy the presentation. The expectation going in is that you have some general knowledge of retirement plans. We don't expect everybody on this call to be an expert in retirement plans, but at least know what a 401k plan is and potentially what profit sharing plans are. And as Andrea mentioned, I am more than happy to field any questions you have throughout the presentation, so don't be shy, fire those off in the question box. This is the roadmap we're going to go through today. Going to do a little bit of introduction, kind of lay the groundwork, talk about various retirement plans, working our way towards cash balance plans, and then we'll spend the bulk of our time talking about that, and then we'll finish off with some typical FAQs with respect to cash balance plans. So retirement plans have always allowed for tax deferrals. They've always been very tax advantageous plans. And some of the advantages of them are things like deductions for the employer, deferral of taxes on the income. The income tax is deferred until the distributions are made. So maybe you'll be in a different tax bracket at that point. And then they are also very well protected from creditors. Generally, retirement plan assets can't be touched by the creditors. So we like to kind of have some sort of guidelines when we're setting up clients on retirement plans. And generally, our goals include things like how understandable is this plan, how sustainable is it, how affordable is it, and administratively, is it doable? Is it easy? As you can imagine, these goals or objectives often conflict with each other. Typically, a very easily understandable plan may not be the best plan from a tax advantage standpoint for the client that you're working with. And so as we walk through these different retirement plan programs, just kind of keep this concept in the back of your mind of, okay, is this plan, how does this plan fit on the spectrum of understandability, affordability, sustainability, and administrative headache? As I mentioned, we're going to kind of work in this framework. And so obviously, as we move up this ladder of retirement plan complexity, they do get more complex, but they tend to offer more flexibility and more bang for your buck, if you will. And spoiler alert, cash balance plans tend to be at the top of the food chain, and that's why we're focusing on them in this presentation. And we'll see a little bit later on why cash balance plans today are much more common for small employers versus 15 years ago. Part of the reason cash balance plans are more popular today is because we've gotten a lot more clarity versus when they were first starting to kind of be rolled out. Cash balance plans have existed, I want to say, since the 80s, maybe even the late 70s, but they were very rare for quite a while. And then they gained some popularity, but there was a lot of uncertainty and some hurdles that you needed to jump over to do them. Well, a lot of those hurdles have been knocked down by various court cases. The Pension Protection Act, PPA of 2006, was a big deal with respect to cash balance plans that cleared a lot of the uncertainty up. And then the IRS has subsequently clarified things even more. Does that mean everything's cleared out of the way for us? No, but it does mean that we have a lot more comfort in putting these plans in place for employers. And as I mentioned, because of that, the number of cash balance plans have been increasing rapidly. In the small plan world, these are the #1 new defined benefit plan type, and I'll talk a little bit later about what that means, defined benefit plan type. This is the fastest growing plan market in the small employer group, and we don't see any reason why that trend would not continue. We fully expect it to. So this is kind of a summary list of sort of all the retirement plans available to employers. The ones in bold are ones that we're going to walk through, and you can see that 401k plans are on here, defined benefit plans, cash balance plans, combo plans. So we're going to walk through each of these and talk about the benefits of each and why you may or may not want to consider any of these plans. We will not be covering SEFs, simple IRAs, or ESOPs on this call. Before we dive into the actual plans, I do want to kind of I guess this is another disclaimer that I will be mentioning a handful of non-discrimination tests. So you'll hear words like ADP, ACP test, top-heavy test. Hopefully I will define what those are, but I think most people are aware of what they are too. But if I throw out an acronym or something like that, because actuaries are famous for speaking only in acronyms, if I throw out one that you don't understand, please feel free to reach out and ask a question, and I will define it. So with respect, oh, yes.
Sorry, we had one question submitted.
Great.
Do we have to always look at clients' income for the past 3 years to determine how much they can put into the plan? Or can we look at current income and future income without looking back? The question is specifically for clients with income leaps this year and future.
Yeah, so that's a very good question, and we'll cover that a little bit later, but the short answer is no, you don't have to necessarily look at the prior 3-year income. Now, you at some point before the plan is cashed out, whether that means the plan terminates or the participant leaves the plan, but typically the plan terminates, before that is cashed out, you will want a consecutive 3-year average of the higher pay. So if you have fluctuating pay and it's every other year, that could be a little bit of a challenge. But if you have 3 consecutive years, that's what you need. And those 3 years can be in the future. They don't have to be in the past. So hopefully that answered your question. If it didn't, please follow up. So the trade-off in these retirement plans, the IRS, probably smartly so, doesn't want us to just give the owners everything and give the staff nothing. And so we have to pass non-discrimination tests. So these retirement plans cannot favor highly compensated employees. So there's certain things that we have to do, and typically this is kind of just some general guidelines. If you have a safe harbor 401k plan, then usually it's a minimum contribution to the staff of 3 to 4%. In a profit sharing plan, typically it's 5%, sometimes less. There's a gateway there. And then in a combined cash balance plan, probably the most common we see is somewhere around $1,000 in the cash balance plan, and then usually a profit sharing plus safe harbor contribution total of 7.5%. And that happens when you max out the owner. Sometimes that 7.5% can be lower if the owner isn't completely maxed out. So 401k plans, I think, like I said, hopefully everybody's familiar with these. A safe harbor 401k plan is where the employer makes a minimum contribution to all participants or to only the NACs, the non-highly compensated employees. And the advantage of a safe harbor 401k plan is you don't have to pass the ADP or the ACP test, the average deferral percentage or the average contribution percentage. And that's because you're giving all the NACEs the same amount. Now, we'll see in a little bit that combining a safe harbor with other plans, there are advantages to that, and one of them being that you get out of some of the testing. So a real simple example here. We have an owner, 2 employees, and everybody gets the same safe harbor amount. So everybody gets 3%. And so by doing that, we get the owner gets, I apologize, I do have a typo down here, but the owner gets over 65% of the total share. They basically get 5850 over 8850. So you can see the bulk of it, even in this simple safe harbor plan, that the bulk of it is still going to the owner, and that's pay driven. The owner obviously is getting 195,000 out of the 280,000 of pay. So not a bad deal, but I don't think you'll be surprised to hear that we could probably do better. So let's talk about new comparability plans. Basically what this is a profit sharing plan where you put everybody into separate groups. And those groups it can be one person in each group, it could be grouped by job title, it could be some other criteria. And then you give that group their own percentage of profit sharing. And the advantage of that is obviously the flexibility of giving different people different amounts. There is a gateway minimum that has to be passed to have these groups, and you do have to test. You have to do a 401A4 test, and I'll talk about that in a couple slides. But basically, you have to prove that this isn't favoring the HCEs in a significant manner. You can give up to, in a defined contribution plan, you can give up to $57,000 per participant for 2020 plus. Anybody over age 50, you can give an additional $6,500. So what would that look like with our sample plan? So here we've added a new comparability plan, and in this case, we've basically grouped the two employees together and the owner in their own group. And so the owner were able to give $37,000 of profit sharing, and the employees, we have that 5% gateway, so we're giving them 3% in a safe harbor plus 2% in the profit sharing. So that gets them that 5%, and we get the owner up to 88% of the contribution in this scenario. So you can see that we're getting even better as far as the owner benefiting under this plan. Now it is costing the owner 5% in staff cost, but that 5% is allowing the owner to get basically $63,000 when you add in the deferrals in their 401k plan. So as I mentioned, the new comparability plan, in this case, and this is in our example, and this is kind of typical of how we would set these up, you combine it with the safe harbor design. So you eliminate the ADP and ACP testing, and then you're varying the profit sharing piece, but you do have to satisfy 401A4, and that's the code section that talks about you can't favor HCEs in these plans. And so that's a test that Nova performs for our clients annually to confirm that it passes 401A4. And then we can combine the profit sharing and the safe harbor if we need to pass top heavy minimum. If the plan is deemed to be top heavy, then there's a minimum contribution that's excuse me, that's required and we can use the safe harbor contributions in satisfying that top-heavy minimum requirement.
Phil?
Yes.
One question. Do those numbers change for the employees if they are close to the owner's age?
In the new comparability, yes, they probably would in this scenario because of the 401A4 testing that I mentioned. That's likely the case. We've conveniently cherry-picked a sample here that minimizes the amount that we have to give the staff because the staff is so much younger than the owner. But yes, I think it's safe to say that question that the staff costs would be higher if all of the employees, including the owner, were the same age. So when we do the test, when we do the 401A4 test, we get to use the safe harbor contributions as part of that test, but we don't use the matching contributions. So that's why which in our sample plan, we didn't have any matching contributions, but we also don't use deferrals in that either. And so that's why the owner was able to max out their deferrals in addition to getting the safe harbor. And typically at NOVA, when we're setting up these plans, we recommend that you only do the safe harbor contributions to the non-highlies. That provides the most flexibility because you can always, you're not limiting yourself. Like in our example, and back to the question that we received, if everybody was the same age and the owner was, and the plan document said we had to give the owner a safe harbor percentage, then we're forced to give the owner that, which means that we still have to pass testing. So as I mentioned as part of the question, the staff costs would go up if they were all the same age, but the other way that you could offset that is you could lower the owner's profit sharing. If we were forced to give them a safe harbor, then we wouldn't have that option, at least on the safe harbor piece. So we typically recommend that when you set up your plan, your new comparability plan, exclude the HCEs in your safe harbor. And we'll see these advantages come into play when we talk about combo plans, and that'll be the combo plan is combining basically a new comparability plan with a cash balance plan.
Phil?
Any additional questions?
Yes, we did receive one. And again, if you do have any questions during the presentation, please type them in the questions box, and that way Phil can answer them throughout the presentation. But of course, if you have a question following the presentation, you can always reach out to a NOVA account manager or reach out to webinars@nova401k.com, and we'll be happy to get your answer to you. And the question is, if an employer has over 100 employees, it seems the cash balance plan isn't the best strategy. Is that correct?
That's not, I wouldn't give that a blanket no. It completely depends on the demographics. You could still, I mean, if the demographics are favorable, I'll give you an easy counter example. If you had two owners and they were in their 40s and the majority of the staff were in their 40s or 50s, then no, that probably wouldn't be very appealing. But if you have two owners who are, in their 60s and the majority of staff are lower paid younger people, it's still a very viable plan. And just remember, the cost of these plans is not, I mean, there's a little bit of administrative cost, obviously, but the majority of the cost is you funding staff's retirement plans. So is that that bad of a deal, maybe not. I mean, you're giving in our example here, and we'll see later, in this example, both of these employees are getting 5% of their pay from the company as a retirement contribution, and they don't have to do anything. They don't have to do their deferrals. We put deferrals on here, but they don't have to do deferrals. They're going to get 5% because they have to get 5%, so the owner can get his $37,000. So so with 100 people, or more, it's not a necessarily no answer. It's we need to look at the data to determine it. Okay, so we are going to make a major leap in complexity here. We've been talking about defined contribution plans, and we're going to switch over to defined benefit plans. And as their name implies, a defined benefit plan defines the benefit that somebody will get at retirement. That's the definition of a defined benefit plan. Defined contribution plan defines the contribution that you will get today. The reason that those are typically easier is it's easier to understand that you give me $1,000, I put $1,000 into my 401k account, and I know how much that's worth. It's worth $1,000. And then if it has earnings or losses or whatever, I can look at it tomorrow and see what that $1,000 is worth. And I can, if I'm eligible to take it, I could take it now and I get $1,000. Defined benefit plan is not that easy to do that. And that's because the plan defines the benefit, and in traditional DB plans, so I'm going to talk about traditional DB plans and then we'll pivot to cash balance plans. But traditional DB plans typically define a benefit such as, show you on the next slide, such as a benefit as a percent of pay, and that benefit is defined as an annuity that you would get at retirement. So in this example here, 10% of 3-year average pay times service up to 10 years at 65. So if my pay, if I was in the plan for 10 years and my pay was $100,000, my 3-year average, and I'm 65 and I quit, I can take an annuity of $100,000 every year. I would get it monthly, but I would get $100,000 a year from this plan until I die. Hopefully you can appreciate how this has become much more complex than a defined benefit plan. I mean, a defined contribution plan, because that's not that hard to figure out if I'm sitting at 65. But what happens if I'm 45 and I'm making 75,000 now? What does that mean as far as my benefit? Well, it all depends. If I work until I'm 65 and my pay changes, then I end up having 10 years, and I would get 100% of whatever my 3-year average was at 65. But if I quit now, and say I quit now and I only have 5 years, I would get, in my 3-year average was 75,000. At 65, not today, but at 65, I would get 50% of $75,000 as an annuity. So it's a pretty difficult thing for, especially for plan participants to understand. It's they can't pull up they can't go to John Hancock's website and pull up their account balance for this type of plan. Historically, this was the standard in retirement plans for large businesses and unions. That's not really the case anymore. The standard now for large businesses in particular is 401k only arrangements. Small businesses have used these for quite a while as tax shelters, basically. And that's the shift that is moving more towards cash balance plans, and we'll see why in a minute. But they are advantageous because, so remembering our spectrum here, we're trying to balance all these competing goals, and if one of the goals is to get large deductions, well, you're going to lose some of your simplicity of a defined contribution plan. These plans, defined benefit plans, you typically get a much higher deduction than any type of defined contribution plan. But there are the additional complications are you're required to contribute. So if you have a down year, you can't just stop the contributions. There are required contributions. And then typically it's harder for clients to understand and harder for you as advisors to explain to clients.
Phil?
Yes.
One question. Who decides what type of annuity the client goes into?
So the plan will define optional annuity forms, and the participant elects the type of annuity. There are some required, so all defined benefit plans have to offer a life-only annuity and a couple different joint and survivor annuities for any married participants. And then there's additional optional forms that they can add on, the most popular one being a lump sum. But all of that has to be elected. The normal form in a defined benefit plan cannot be defined as a lump sum. We'll see in cash balance plans that the benefit always looks like a lump sum, but the normal form under the plan has to be defined as some type of annuity. And they always have to have that option to take an annuity. But it's the participant who makes that election at retirement. So in defined benefit plans, there are maximums, just like in defined contribution plans, but in defined contribution plans, those maximums are maximum contributions you can make. So like the $57,000 in 2020, plus any catch up if eligible. In defined benefit plans, these maximum benefits are maximum annuities that can be paid out at retirement. So and again, these are lifetime annuities. So the maximum in 2020 is $230,000. Contributions in the plans, because again, they're complicated and there are required contributions, you do have to engage an enrolled actuary to calculate the minimum required contribution and the maximum deductible contribution. The other kind of complication of these plans is that these plans, that the benefits are an obligation of the employer, of the sponsoring employer, because remember, these are promised future benefits, not contributions that are going directly to participants today. So quick little pop quiz here. In a defined benefit plan, who can get the largest benefit out of these three sample people, we'll call them? Jeff Bezos, Tom Brady, or a small plan owner? And I will jump right to the answer. Hopefully everybody's caught from the prior slide that it's actually all the same. Doesn't matter if you have Jeff Bezos money or you're a small plan owner. The maximum amount of annuity you can get starting at age 62 under the rules is $230,000 in 2020. And then that 230 gets reduced for ages before 62. So if Tom Brady were to actually retire at 45, which I think he's already close to 45, his maximum benefit would be $6,500 per month, which might pay for Giselle's personal trainer, but probably not.
One question, Phil. With the complexity of defined benefit plans, is there a large difference in the cost for the administration of the plan?
That is a very good question. I don't know how you would define large. I will say that there's additional costs because there's additional requirements. There's the requirement of actuarial valuations. There's a requirement of when people want to take their benefit. There's the benefit calculations. There's government filings. The Form 5500 is there's additional schedules that go on the 5500, one of which is signed by the actuary. And then also the plan, depending on your plan might be covered by the PBGC. And the PBGC is basically a governmental insurance agency for defined benefit plans. And so there are premiums required for that. That's probably the piece that might look like the most expensive as far as difference between DC and DB plans, because right now the PBGC premium is, I think it's $83 a year per person. And then if your plan's underfunded, there's additional premium on top of that. That is definitely something that needs to be weighed in setting these plans up. Is there is additional administration cost for sure, but it may be well worth it based on what the owner could get, and we'll see that in some upcoming examples. So cash balance plans. So the power of a cash balance plan, and this is actually true for any DB plan, but we'll see why cash balance plans are a little nicer than traditional DB plans. But the maximum lump sum, so we've converted our annual annuity benefit to a lump sum. The maximum lump sum you can get out of a defined benefit plan is, you can see it goes all the way up to $3 million at age 70 if you have 10 years of service. So the leverage there is huge, especially for older employees. And even 55, even a 55-year-old. So if you have a 45-year-old owner, in 10 years, they could get $2 million out of this plan. Now these numbers are reduced if your years of participation are less than 10, and it's basically 10% a year. So a 70-year-old who had 5 years of service, their max lump sum would be 1.5 million. But if you think about that, if you fund 1.5 million over 5 years, that's $300,000 that you can put away in a defined benefit plan. And in a defined contribution plan, you would be limited to the 57,000 or 57,000 plus catch-up. Now, to get this maximum, there are some max salaries that somebody would have, and this, I think this kind of relates to the pay question we had early on. And this salary required column, that's a 3-year average required, and it's a 3 consecutive average. So again, if you have $1 million of pay in 1 year and 0 the next, then that's not necessarily helping your average. I mean, your average is still 500,000, so you're over that. scenario. But if you do, you do need 3 years average. And the approximate maximum deduction that you can take based on these salaries by age is the middle column on here. So if you have a 60-year-old owner making at least $200,000, $201,000, then they can deduct $265,000 a year. Again, just put that in perspective, comparing that to the $57,000, you can see the advantages. No, as I mentioned, cash balance plan is a DB plan, but it looks a lot like a DC plan. So the beauty of them is it's stripping out some of that complexity of when you're talking to your clients and you're trying to explain this, you don't have to explain it as a benefit that's going to be paid at 65, even though it's a defined benefit plan and it does define the benefit. But in this case, it defines the benefit as a hypothetical account balance. And it's a hypothetical account balance that gets interest every year. So you have a allocation every year, an annual allocation, and then you have an interest credit every year. So you can almost think of it as a profit sharing plan that has a guaranteed return. Again, enrolled actuary has to be involved because it is a defined benefit plan. And the assets are held in a trust, not individual accounts. And so the assets won't necessarily equal the liabilities. And we have some in the FAQs, I have a little more detail on that.
Bill, we've had 2 questions submitted.
Perfect.
And the first one, does a percentage of the money for defined benefit plans have to be set aside each year? What would happen if the employer couldn't pay out the annuity?
So the money goes into a trust, and the trust is what's used to pay the benefits. And so that question is a little difficult to answer because it kind of depends on, I mean, let's talk about a plan termination situation where you shut the plan down and you pay everybody out. Because you can't get this money unless you leave the company or the plan terminates. So if you're a participant in one of these plans, you can't take the money unless you quit the company or the plan shuts down and then pays everybody out. So if you have a plan termination and the plan is underfunded, if the plan is covered by the PBGC, then the PBGC will require you to fund it up to pay out those benefits unless you have a majority owner. If you have an owner who's over 50%, they could elect to reduce their benefit, but all the rank and file employees have to get their money. They have to get paid out. So I hope that answered your question.
And if anybody wants to make follow-up questions, if you ask a question and there's a tag-on question, please just type it in the questions box and we'll get that answered. The next question we received is, are all cash balance plans required to pay PBGC premiums?
No. The plans that are not covered by the PBGC plan or by the PBGC are plans, there's really 2 primary ways that you get out of PBGC coverage. Now, I will show you in a little bit that there's actually advantages to being a PBGC covered plan. But if the plan only covers owners or owners and spouses, then it is not required to be covered by the PBGC. And then there's certain groups of employers that are not required to be covered by the PBGC, and those are basically service organizations. So think doctors, lawyers, accountants. that kind of group, those plans are not required as long as they have less than 25 employees. So those plans, they can trip into PBGC coverage if they have a lot of employees, but those plans are not required to be covered by the PBGC.
Next question. When an employer contributes over a certain amount, does it send a red flag to the IRS?
No, and the reason being is because the actuary will calculate a minimum required every year, but also will calculate a maximum deductible. And you can't contribute more, well, you can't deduct more than that maximum deductible contribution. So, and if you do, then you're supposed to tell the IRS, well, you have to tell the IRS that you did. You have to file a 5330 form. There's no penalty, but you do have to file a 5330 form saying, hey, we contributed more than our maximum deductible. So in that situation, yeah, that definitely the IRS would be made aware that you did. But typically, as long as you stay in that corridor between the min and the max, then there's no issue. And that max, after about 3 years, that maximum deductible, in the first couple of years of these plans, that corridor is pretty tight between the minimum and the max. After about 3 years, that maximum gets pretty big. There's a lot of leeway there. Basically, the IRS allows plans to fund pretty much 150% of their liabilities. They want these plans funded. They want these plans funded. They want defined benefit plans funded because of the typical traditional defined benefit plans that covered unions and covered large companies. But all the rules are the same, whether you're a small company or a big company. And so the small companies can take advantage of this maximum deductible being high. Now, I will caution you, and I think I have it on one of the slides, that you can overfund these plans too much. If you remember the slide of the maximum right here, if you only have one person in your plan and that person is 65 years old, you don't want to be above 2.7 million because you can't get all of that out. You have what we call trapped assets, and to take that excess out, you would potentially be subject to an excise tax, which can be up to 50% on the excise, not on the 2.7, but anything above that. So that would be the only caution of overfunding these plans.
Okay, I think we'll take one more question and then we'll continue on the slides and we'll address a few more questions in a little bit. If for any reason time does not allot for us to answer all the questions submitted, we will get you a response. It may not be till later this week or next week, but we will give responses to all questions received. Okay, so one more question right now. Who chooses the investment in the plan? Is it the employer or the employee?
It is the trustee of the plan. And the trustee is going to be a named person or persons in the plan, and that those people choose the investments in the plan. So you can invest aggressively or not, but if you see my example here on the screen, for this one participant, their hypothetical account balance is growing at 5% a year. So if you don't meet that 5% bogey for the plan, then you're going to have to fund that difference. Now you'll get to fund it over time. You don't have to fund it all at once. The rules allow you to fund it basically over a 7-year period, but you will have to fund that difference. So you can, the trustee can invest however they want, but the benefits, because it's a defined benefit plan, the benefits are defined. And this participant, if this participant quit on 1/1/2021, they could get $3,100. They would get $3,100, $3,153 from the plan. The plan would owe them that. Those are great questions. So let's look at a sample of a plan design where we have an owner, and you can kind of see we're setting this up almost like a new comparability plan. We have our classes and we have our contributions. So in this case, we're gonna give the owner 75% of pay as a hypothetical allocation or contribution. We're gonna give all other HCs 20%, and then all others, which is all the NACEs, we're going to give 15% of pay. We will be required to test this annually to confirm that it does not discriminate in favor of the HCs. So here's our data. We have a nice group here. Our owners are older than our employees, so that helps us with our non-discrimination testing. So we're going to give the owners 75% of 285. The max comp that we can use in these plans is defined. And so if they make over, for 2020, if you make over 285, the max comp we can use is 285 in these types of plans. So we're going to give them 75% of that. That's the 213,750. And so as a standalone plan, we've now gotten up, if you remember our new comparability plan, I think we topped out at about 88% for the owners. Now we only had 2 staff members and 1 owner in that situation, but it was 88%. We're now up to 93% of the contribution going to the owners. But wait, there's more. Gets better. If you act now, we're going to throw in a new comparability plan on top of this baby. And then you can see we leveraged that even more. So if you combine this with a DC plan, you do have some additional requirements, and typically the most common is you now have a maximum gateway that is probably 7.5% if you're maxing out the owners versus 5%. And then, as mentioned before, if you have the safe harbor 401k design, then that helps in passing the gateway and the testing. So let's look at our sample again real quick, and I'll just go straight to the bottom line. Basically, we were able to reduce the staff cost because we lowered the cash balance allocation. We're not giving them 15% as a cash balance allocation anymore. We've moved a chunk of that to the 401k plan via safe harbor and profit sharing. And we reduced the staff cost by $14,000, and we got an additional $130,000 in 401k deferral and profit sharing for the owners. So even better, we're over 96% now of the dollars going to the owners. So I'm gonna skip ahead because I know we're running a little late on time. But I did want to mention real quickly that there are some additional advantages under the Tax Cuts and Jobs Act that was passed a couple years back. And basically, if you're a pass-through entity, there's an additional 20% deduction. And if you're a specified trade or business, and you can go back later if you want to read what groups are in there. But if your taxable income is greater than $415,000 and you're a specified service trade or business, then the 20% QBI starts to phase out. So if you're in one of those groups, you may want to think about tacking on a cash balance plan to get your adjustable gross income down, or your taxable income down, to get your tax bill down. So real quick example, Sally, our CPA, without a cash balance plan, her estimated taxes are about $142,000. She puts in a cash balance plan, puts $230,000 in that, and her tax bill goes down by almost $100,000. So great deal for those groups. As an actuary, I have to explain my assumptions that I used in that sample, but they're there on the screen.
Still, new question.
Yes. Yep.
Can you have a combined plan, but only a cash balance plan for the owners only?
Yes. The profit sharing piece for the owners is always optional. So yeah, that's pretty common that the owner puts everything in the cash balance plan, and then the 401k plan is primarily for the staff. Do we have any more questions?
We have a few more, but because of time restraints, we'll go ahead and go through the FAQ, and if we have time, we might get to a couple more.
Okay. I think I've answered some of these, so I'll try and go quickly through them. But typically, you want to look at your professional organizations, your dentists, your attorneys, your physicians. These are very appealing to them, especially with that additional potential tax savings if they make over $415,000. If we can add in one of these plans and get that income down, it's even more significant. Owner-operated businesses, especially for older owners. And then, you know, we've got the question already about a large company. The other advantage of a large company looking at this at a cash balance plan is it offers a great benefit, a defined benefit that an employee can easily understand. And then additional companies, if your company already has a new comparability plan, then it might make some sense to look at it. They're already used to paying for the gateway minimum on that. If we have a discrepancy between the owner, if the owner is somewhat older than the staff, 10 years or more, these are very, very appealing plans. So as I mentioned, if you already have a new comparability plan, you'd probably be interested in it. Usually we can add a cash balance plan with marginal additional staff cost. So if you'd like us to run a illustration for you to show you what the additional staff cost would be if you already have a new comparability plan, let us know and we'll get that over to you. I think, I mean, when these questions, if these plans are so cool, why haven't I heard of them? I think most people now have heard of these plans. The interest crediting rate, we get this question a lot. Can I tie my interest crediting rate to my rate of return? And the technical answer is yes. The advisor answer from Nova, what we advise our clients is typically no. We would discourage it. Go ahead and invest your assets how you want, but have a simple interest crediting rate. Then you don't have to worry about these potential hiccups or these pitfalls, such as testing. And there is a preservation of capital rule. You can't, everybody's account cannot be lower than the sum of all their contributions, all their allocations. So basically you can't have a less than zero interest crediting rate for the lifetime, not annual. So we strongly discourage tying the interest crediting rate to the return on plan assets. We already answered that question. If you have a client that has a defined benefit plan and is interested in converting to a cash balance plan, it is something that we do, and it's nice for the staff because of the understandability of these plans. So if you would like us to look at doing that for you, we're happy to look into that. Defined benefit plans, including cash balance plans, are required to cover a minimum number of participants. If you only have 1 or 2 employees, then you have to cover all of them. Otherwise, you have to cover 40% of the employees. If you have a large plan, like was mentioned earlier, 100 people, you only have to cover 50, which in that case would still be 40%. But if you have a group of lawyers, of 300 lawyers, you only have to cover 50 of them. And then I mentioned the gateway. The gateway is on a sliding scale, so it'll be anywhere from 5% to 7.5%, just depending on how much the ACs get. And then there is in the regulations, there is a permanency requirement. And so if you terminate your plan after just a few years, then you probably want to have a pretty good reason. Selling the company is a very good reason. I just don't want this plan anymore. That's probably not as great of a reason. And the IRS has indicated that they'll look at ones that haven't been around for at least 5 years. So you're ready to jump in and adopt these plans, I'm sure. So what are the deadlines? Well, the Secure Act actually has extended the deadlines. Typically, these plans needed to be put into place by 12/31 for a calendar year plan. That's not the case now. You actually have pretty much until your tax filing date of the following year to put in a plan, but NOVA recommends that you do it by January 31st, because obviously if you wait until your tax filing deadline, this plan is going to impact your taxes. And so you want to have time to set up the plan, get the plan established and all that stuff. So we recommend January 31st. And for NOVA plans, if you want to adopt it by December 31st, then we'll need to have a signed illustration indicating that you would like to establish this plan. We need that by December 11th. But remember, if you don't meet that December 11th deadline, that doesn't mean you can't put in a plan for 2020. You have time next year to put in a plan as well. And as Andrea mentioned, the CE credit, whether it's CPA or CFP, the evaluation form should be popping up here shortly, and then you will receive your certificate. If you do have additional questions or you want to see any type of illustration or would like a consultant to call you, then email this address here, proposal@nova401k.com, and one of our representatives will contact you. So that's all I have, Andrea.
Hi. Well, we are 6 minutes over, but we'll go over just a couple questions. We're probably not going to get to everyone's. Again, we will have someone reach out to you and provide an answer directly to you via email. Again, it may not be today, it may be later this week or next week, but you will get an answer to your question. Also, as Phil mentioned, as a reminder, it is very important, if you would like to receive CE credit for today, whether that is Texas CPA or CFP, please complete the survey that will pop up after we close the webinar. There is information that I need to register your CE. Specifically for CFP, I need your board ID number as well as the last 4 of your social. So it is very important that we receive that information so we can make sure you get credit. Also, we will send you a certificate of attendance for your records within 1 week via email to the email that you registered with. Today's recording will also be made available on our NOVA YouTube channel. Just go to YouTube, type in NOVA 401k Associates in the search bar, and you'll see this webinar within a couple days, as well as other webinars that we have hosted over the past year. All right, just a couple questions. Can a company with 100 employees provide a cash balance plan only to the 3 owners?
No, because of the minimum participation test that I mentioned. So if it has exactly 100, it needs to cover 40, but it can cover them at a minimum amount. And so basically, and it gets a little complicated, but you basically need to give them a benefit that's the equivalent of an annual accrual of 0.5% of pay as a annuity at retirement. So if you have a 25-year-old making $25,000, you probably get there by giving them $250 in the cash balance plan. And so in that situation, the way we would set it up is you max out the 3 owners, and then you give 40-ish people. You probably want to do 50 people just because of turnover and stuff. You give 50 people a minimum benefit, whether that's $500 or $1,000, whatever it takes to pass this 401(a)26 requirement. Excuse me.
Going back to the maximum benefit, the slide where you had the 2.7 for the 65-year-olds, can you roll that excess into an IRA?
You can roll the 2.7 into an IRA. The excess, you would still owe excise tax on the excess, whether you rolled it or not. Now, I'm not a tax expert. I would check with your CPA to verify, but I'm pretty sure that's what happens. You can only, because the excise tax comes due on the fact that you're paying out a benefit above the maximum allowed benefit under a defined benefit plan.
What does a plan look like if it's run by the owner who has no other employees?
It looks a lot like a 401k plan. I mean, it's, you know, the assets are still held in a trust and belong to the employer, but that employer is the owner. So, and they can invest however they want, just keeping these maximums in mind that they don't go above that. But no, it looks very, very similar to a 401k plan. I don't know if that is exactly the question, or if they're talking about you know, what can you do in that plan as far as deductions, and that's this slide, right? If it's an owner only, you can put in 280,000. Now you would be limited on a DC plan to 6% of pay, but you're getting, if you're 65 years old, you're getting 280,000 in this plan plus 6% in your profit sharing plan, plus deferrals. You can do deferrals too. So hopefully that answered the question. I wasn't sure if you were talking about annual deductions / contributions, or just in general, how does it look?
All right. Well, we had several questions that we were unfortunately just not able to get to, but that's great. So we will respond to you directly via email and get you an answer. Again, if you have any questions, please contact the email right there, proposal@nova401k.com, if you would like an illustration or if you have specific questions about cash balance plans. You can also email webinars@nova401k.com if you have any questions, or if you'd like a link to the recording. If you have any questions about a CE certificate, email webinars@nova401k.com and I'll be happy to help you out. Thank you everyone for attending. We really do appreciate you taking time out of your busy day to attend. Thank you, Phil, for presenting. I appreciate it. And everybody have a great day. Again, look out for that pop-up survey to give us your information for CE. Everybody have a great day.
Thank you.